next speaker, my colleague, Marjorie McPike.
Okay. Let's go to the live on Instagram. I can't do it. Okay, so I'll just do this. Hi, everyone. I'm Marjorie McPike. I'm a CPA in Southern California, Wildomar area, right around the corner. I'm also, I'll do that part, but let me just say, so my section of the presentation is overcome your fear of the government, and accountants got your back. So,
Marjorie, I don't think on Zoom here, we can see the same screen you're seeing.
you can't see the same screen?
I believe you may have to reshare the screen from Zoom possibly.
Thanks for letting me know that, Brian.
Definitely.
It should be. Is it this one? Okay.
There we go. Yeah, that's good.
Okay, awesome. Thank you, Brian. Okay, so my name is Marjorie McPike. I am a CPA. I also have my master's in taxation. Yeah, that one. I am the corresponding secretary for the Alliance of Black Women Accountants. I'm also one of the founding members. I have my own firm. I'm a solo practitioner, went out on my own in December of 2020. And I specialize in tax preparation, tax strategies, tax planning, and accounting. So what I want to talk to you about today is tax compliance, the filing dates, tax notices and responses, entity structure and the taxation of those entities, tax planning, tax strategies, and how accountants can help. So tax compliance and filing, if you formed an entity and with the state and you have an EIN, you're required to file a return. It doesn't matter if you have a loss. It doesn't matter if you didn't really start doing any business. You're still required to file a return because you formed your entity. If you are a partnership or an S corporation, those returns are due most likely 3/15 if you're a calendar year corporation or calendar year entity, April 15th for individuals, corporations, single member LLCs, and I think trusts. There is a 6-month extension, so a lot of people will not file the return on time and they say they're just going to get an extension. The extension is an extension of time to file your return. It's not an extension of time to pay. So if you owe a balance on your return, you're responsible for making that payment at that time. So one of the things we wanted to talk about is what to do if you receive a notice from the IRS. The first thing is don't panic. Okay, everyone, when they think of the IRS, they're like, oh my goodness, I got a notice, I have a notice. Don't panic, make a phone call. You know, first of all, read the notice and see if you can understand what it's saying. Forward a copy of it to your tax professional. And remember that the IRS is not all knowing, they make mistakes. So they may have, you know, entered something incorrectly, or there may be something that's not matching. And it could just be a simple response. So don't get overwhelmed and don't panic if you get a notice from the IRS or the Franchise Tax Board for that matter. Even the CDTFA for sales tax. Don't get nervous, don't panic if you get a notice, reach out to your tax professional. Let me go back one. So a lot of times with a notice, looks like my slides got a little bit mixed up and I'm not going the right way. Uh-oh, sorry guys, this way. It shows that I'm human. So a lot of times with the notices, the IRS is pretty lenient. So like I said, they don't always have all the information. They may not have the information. They may have received mismatched information because the IRS is tracking. So they're matching. Like if you issue a 1099 to someone, a copy of that is to go to the IRS. If you issue a W-2, the IRS gets a copy of that. So there could be that it's just missing information that's not matching. So don't be afraid to, you know, when you get the notice. And then they also have penalty relief, right? So there's like a first time abatement if you get a penalty where you can just call them and say, hey, I got this penalty. And they'll tell you, you know, well, this is the first time that you had this penalty, we can abate it for you. And it could be a phone call where you can just do that over the phone without having to reach out to someone and you know, send a letter and, you know, go through all of those different rigmaroles. So be aware of that. you can always call the IRS and make arrangements. So I had recently a client that they formed an S corporation, they filed the return late, and the IRS assessed penalties on the corporation, and the penalties were about $60,000. So it's like it was two different entities. Made the phone call and we were able to get the penalties waived. So, and then another situation that happened is I had, say for instance, you get a notice and you ignore the notice, and then the IRS starts, or the franchise tax board, they start garnishing your paycheck, right? You can't get that. You can get back money that they've garnished up to a year from the time when they took it out. I had people where they would go like 2 years and the IRS is taking money from them and they never make the phone call. And so by making the phone call, filing the returns, they were able to get most of their money back, but not all of their money back because that year period was passed. So you want to make sure that you're doing that. And there was something else I was going to say. I'm sorry. It'll come back to me. But just, make the phone calls. If you get a notice, follow through with that. And don't be afraid of the IRS. So let's talk about entity structure. So Neff kind of outlined the different types of entities that you can form. So the sole proprietor is, of course, the easiest entity to form. You just start doing business. You report it on your Schedule C, you file your income tax return. One of the things about a sole proprietor is that you're subject to self-employment tax. Self-employment tax is 15.3% of your net income or your self-employment income, and that could add up. So self-employment tax is in addition to your regular tax. So you take your W-2, you take your interest income, your business income, all of that, and you come up with a number, and that becomes your taxable income. You pay tax on that, but then your self-employment tax is an additional 15.3% of your self-employment income on top of that tax. So it could add up. So you want to make sure that you are, kind of watching this, and we'll talk about that in tax planning, but making sure that you are understanding your tax return. That's a big thing for me, is understanding your tax return, how it's calculated, and how things are going to affect your return. So an LLC single member, it's a disregarded entity. You find a lot of people are pushing LLCs, file an LLC, file an LLC. But they don't realize that an LLC that's a single member, it's just me forming an LLC, it's not recognized by the IRS, so it's going to show up on my individual tax return. There is liability protection, which is a big reason for forming an LLC. You report the income on your Schedule C, just like you're a sole proprietor, and you do pay the self-employment taxes on it. So if you're forming an entity with the goal of not having to pay the self-employment taxes, the LLC is not going to help you. You would need to make an election to be taxed as a different type of entity. And another thing with a single member LLC, same as with the sole proprietorship, is that you cannot pay yourself. So people always want to know, how do I get money out of my entity? You can't pay yourself a salary. You can withdraw the money and it's considered a draw or a distribution, but you can't pay yourself a salary. That may not be a big deal to you, but it plays a part in, say, like Antonio was saying, with, qualifying for a home or something, so you want to make sure that you're in the right entity when, if that's a factor. So an S corporation is a separate legal entity. It limits your personal liability, and the income and deductions are reported on a K-1. So what happens is that the S corporation files its own tax return, and you as a shareholder in that S corporation, you get a K-1, and you take the income from the K-1 and you report it on your individual tax return. A couple things about the K-1 is that there's no self-employment tax because you're paying that at the entity level. And as a shareholder, you can pay yourself a salary. So you have a W-2 and you can deduct it. And then that's how the self-employment taxes are paid. So I always tell people that it's not that you're not paying the self-employment taxes, you're paying them a different way. So you're shifting it, right? So instead of just giving the IRS your $15,000 on your $100,000, you're deducting part of it as a business expense because you're a business. So it's just a way of shifting the way that you pay it and how you can lower your tax liability. And a C corporation is what we kind of know as a big corporation. It's you think Amazon, Walmart, those are big C corporations. It's a totally separate entity. There's no tax liability. So all of the tax liability is at the entity level. So you wouldn't pay any taxes. The corporation would pay the taxes. There's no self-employment taxes. There's no personal liability because it's all on the corporation. And as a stockholder, you would receive dividends. So when a company would pay out dividends, think your broker statement, you know, that's a C corporation is paying out dividends. And so that's what you would pick up on your income tax return. And then the owner or stockholder can also receive a salary. There's not a requirement for a C corporation to receive a salary, but there is a requirement for an S corporation. An S corporation shareholder has to receive a reasonable salary. So the entity structure is unique. So every situation is different. And every entity is different, right? So the goal is to, you know, you should discuss it with your attorney or your CPA, the best structure for you and your business. LLC for rental property. So that's kind of a standard, you know, if you talk to any CPA, they'll tell you that they recommend that you put your LLC in a rental property. It has to do with the appreciation of the property and how it's taxed. So you would want to do that. And an S Corp, sorry, I moved myself around so I can see what's behind here. So an S corporation, if you need to pay yourself a salary, and then there's basis issues for losses. So each entity, the goal is always to make money in a business, right? But you may have a situation where you have losses. The way the losses flow through your tax return, you want to be able to deduct those losses. So you may have in an S corporation, it's basis. So you want to make sure you have basis in the S corporation, the same as in a partnership. So tax planning. Tax planning is proactive and not reactive. I wanted to share that one. We had someone ask me, how can I help them with their taxes? How can I make the numbers look better? It's like, I can't do anything with the numbers after they're done, but if you have a conversation with me now, we can work on next year's numbers. So it's all proactive. So in tax planning, you're looking at your expected income for the year. So say, for instance, we're in June, right? So you would take half a year's income and you would analyze what you anticipated to be for the end of the year. The same with your deductions. And then you would determine what your estimated tax liability is going to be. And you would make recommendations for ways to reduce your tax liability. So say, for instance, if it's, you know, a business owner's at the end of the year and they need equipment, you know, so a good thing that you can do is you can purchase a piece of equipment because that would reduce your liability because of the depreciation, and it could be bonus depreciation and Section 179, you know, kind of too many terms, but it's different things that we look at to see how we can reduce your tax liability. You know, even as an S Corp shareholder, it could be paying yourself a bonus, contributing more to your 401k, you know, contributing to a profit sharing plan, you know, all of those things that are going to reduce your income so that you don't have to pay it out in taxes. I have a client now that I need to send them their return, and we didn't talk at all last year, and their net income ended up being like $83,000. And when you look at it, you're like, oh, $83,000, but you add that to $115,000 in wages, and you're looking at a $30,000 federal tax bill, right? Had we had a conversation, it's, hey, let's set up a 401k, let's pay yourself a salary, let's put more withholding, you know, different things that you can do in order to reduce your tax liability. So having that conversation is important. And I like to say, you know, don't just think about taxes at tax time. Taxes is a year-round process. You should always be looking at, you know, what you're making, not just for businesses, but for individuals as well. You know, what you're making, how you're making it, you know, what you can do differently. Even for an individual, it's like, okay, is my withholding correct? You know, can I contribute to my 401k? Will that make a difference? You know, did I take the standard deduction or did I itemize last year? So all of those things you should be looking at. And then you can calculate your estimated tax payments. So the federal tax system is a pay-as-you-go system. As an employee, you take federal withholding out every payday, right? Every time they pay you, they take the taxes off right off the top. People don't even realize that there's, was it 7.65% for Social Security and Medicare? There's like 1% for SDI. So it's like almost 10% of your taxes, of your salary that comes right off the top in mandatory taxes, right? So then you have your federal withholding and your state withholding. But looking at those and seeing, so it's a pay as you go. So you're paying into that every payday. If you're a business owner, you're required to do the same thing. You're required to make estimated tax payments, and you can't make estimated tax payments if you don't know what your estimated income is going to be or your estimated liability. So that's part of tax planning. And then when it comes to tax strategies, the goal with tax strategies is to look for ways to reduce your taxable income. So say, for instance, you're an S corporation. Would it be to your benefit to form, I'm sorry, if you're a sole proprietor or an LLC, a single member LLC, would it be to your benefit to form an S corporation so that you can start paying yourself a salary, so that you reduce, so that you eliminate the self-employment taxes? So that's a big thing that we look at. And if you're a sole proprietor, we kind of look at it as like the number is about $50,000 in net income. So if you're making more than $50,000 in net income, you need to change your entity structure. If you should pay yourself a bonus, like I mentioned, the S corporation, they're on payroll, you can pay yourself a bonus. It's going to shift the income, reduce your taxable income. Give to charity. Even as an S corporation or a business owner, you can still give to a charitable organization. Individuals, that's one of the ways that I always tell people to reduce their taxable income. We have a lot of people that are making, $200,000, in wages. And they're like, how can I reduce my taxable income? I'm like, well, give away some money. It's not limited. Well, it's limited to, it was 100% of your AGI for 2021, which is up from before it was 50%, but it's still a good number that you can give away. And then, again, instead of just giving it to the government, you're giving it to something that you enjoy or that you feel fondly of, right? So give to charity. Sometimes in a business, you can take a loss in the current year instead of pushing it to the next year if it's going to offset your income. And that applies to, like, for stock traders, right? If you're trading stock and you have a big loss on your on an investment, it may be to your benefit to cash it out now, take the losses to offset some gains, and then it's going to reduce your income. And then keep in mind what new tax laws are coming into effect. So what can you do differently? That's a big thing. Always looking at it, like I said, have the conversation throughout the year. Don't just wait until tax time. Always be speaking to your CPA or your tax professional, especially if you're a business owner. You should have a meeting at least quarterly to discuss what's going on in your business, how things are changing, what your income is looking like, to see what you can do differently. For individuals, you can increase your deductions. We talked about charitable contributions. I'm sure there's a difference between itemized deductions and standard deduction. Of course, with the standard deduction being so much higher, a lot of times it's, people will take the standard deduction, but it's still something to look at to see, you may be, really close to what the standard deduction limit is, and, putting a few more dollars into an investment or into like a charitable organization or doing something different, it may make a difference. And then as always, if you're employed, adjust your withholdings. So how can accountants help? One of my big things is education. When I went out on my own back in 2020, the reason for it was because I saw so many people that were making money, whether it was in the stock market, digital products, starting a business. So many entrepreneurs were developed in 2020. And my goal was to educate. So that's how accountants can help. Education, we can explain to you the differences, between the different entity structures, whatever it is, whatever you have a question about, reach out to someone, reach out to me, ask your questions. Lots of resources out there. Communication, again, is important. You have to communicate with your accountant, excuse me, more than just the end of the year. Support. And we're supposed to be your trusted advisor. We can't be your advisor if we don't know the information. And then we're part of your team. You need to have at least your accountant, your attorney, and your financial advisor on your team. We're part of your team. I think that's it. Questions?